Unit 5. Recording of business transactions in accounting books. As we observed in the previous unit, economic categories in accounting are based on several basic concepts related to business activities of a company. Business activities are the main activities of the company that primarily generate revenues, the activities related to the production and sale of goods and services, with the exception of investment and financial activities. In this section, the issues of accounting recording economic categories will be explained. Economic categories primarily refer to assets, liabilities and equity that are included in the financial statements. After reading this unit, you will become aware on how different economic categories are recorded in accounting. Learn more about long-term assets, short-term assets, liabilities and equity. Introduction. The first book about double entry system was written by an Italian mathematician Luca Pacioli together with Leonardo da Vinci. This book was published in Venice in 1494 and today we still follow double-entry principles set down by Luca Pacioli in his book. The double-entry principle states that every business transaction has equal and opposite effects in at least two accounts. It increases one account and decreases another account. For entrepreneurs, it is especially important to use and understand double-entry system because it helps to maintain the accuracy of financial reporting, reduces errors and fraudulent activities. Accuracy is achieved because double-entry accounting involves the matching principle through the recording of both the revenue and the expenses in the same time. Error reduction is achieved by checking whether a double entry is balanced or not. Every double entry should be balanced, meaning to have the same amount on both sides, debit and credit. Fraud is reduced by the fact that every double entry leaves a trail, so the users or business owners can track the transaction and see how it occurred and when. All double entries are posted to the general ledger. Therefore, the general ledger reflects all the financial activities of a company. Business owners can review from where funds came from, where were transferred, how much a company borrowed from third parties compared with assets of the company and cash it has. The general ledger organizes transactions into accounts. There are 5 major accounts in general ledger. Assets are the items the company owns. Liabilities are amounts that company borrowed. Equity is the capital of the company, value of assets after deducting all liabilities. Revenue represents sales of the company. Expenses represent amounts paid for operating the company. Every big group of accounts mentioned above will be divided into smaller subgroups. In double-entry bookkeeping, each journal entry or transaction requires a debit and a credit of equal value. One account received the debit and other account received the credit, but that debit and credit can be split among multiple accounts. Debit represents an increase in asset or decrease in liabilities and credit represents decrease in asset or increase of liabilities. So basically, debit is adding something while credit is deducting something. In bookkeeping, accountants are using DR for indication of debit and CR for indication of credit. Some examples. Increase in assets like the acquisition of equipment will be shown on debit side, adding of an asset, doctor equipment. Settlement of a liability, like loan payable to other company, will be shown on the debit side, since we will reduce our cash asset through crediting of cash account. II. Assets. To carry out its activities, an enterprise needs assets, which represent the resource that the company uses to carry out its business. According to lifespan, assets are divided into A. Non-current assets. B. Current assets. Non-current assets are such assets that are expected to provide economic benefit to the company for more than 1 year. Non-current assets are also known as fixed assets, long-term assets, etc. An asset should be classified as current if the company expects to realize this asset, or intends to sell or consume it, in its normal operation cycle. If it holds the asset primarily for the purpose of trading. If it expects to realize this asset within 12 months after the reporting period. Or this asset is cash or cash equivalent. The operation cycle of a company is the time between the acquisition of assets and their realization in cash or cash equivalents. Therefore, all other assets will be classified as non-current. There are many ways to classify assets, non-current and current, intangible and tangible, monetary and non-monetary, liquid and not liquid, etc. Classification of assets helps to the company owners to understand the financial position of the company better. For reporting purposes, assets are classified for current and non-current with subclassification on the face of the statement of financial position. This subclassification helps to understand possible benefits and its extent that the company may be able to receive or generate from those assets in the future. Non-current assets. Non-current assets consist of tangible assets, land, building facilities, property, plant and equipment, etc. Intangible assets, research and development expenditures, patents and licenses, trademarks, investments in other assets, goodwill, etc. Financial assets and investments, shares in affiliated companies, investments in long-term securities. Non-current receivables, from affiliated companies, from a third-party loan, deposits and receivables within more than 1 year. Non-current tangible assets. Property, plant and equipment are long-term tangible assets acquired to be used in business operations and the company has no intention to sell them. However, if the company acquired any equipment with an intention to sell it, then this asset will be treated and posted as inventory within the category of short-term current assets. Example, a cargo vehicle in the car salon is part of the inventory because it was acquired with the purpose of sale within an operation period. However, if the same cargo vehicle is sold to a furniture shop, in order to be used to deliver goods to customers, it will be posted under the category of non-current assets within property, plant and equipment account because it is expected that this cargo vehicle will be used in operation for more than 12 months. Initial recognition of property, plant and equipment. The cost of an item of property, plant and equipment shall be recognized as an asset if, and only if, it is probable that future economic benefits associated with the item will flow to the company and the cost of the item can be measured reliably. The item of property, plant and equipment that qualifies for recognition as an asset shall be measured at its cost. The cost of an item of PPE can comprise its purchase price, including import duties and non-refundable purchase taxes, after deducting trade discount. Any costs directly attributable to bringing the asset to the location and condition necessary for it to be capable of operation in the manner intended by management, like delivery and assembly costs, cost of testing for functioning, professional fee etc. The initial estimate of the cost of dismantling and removing the item and restoring the site on which it is located, the obligation for which an entity incurs either when the item is acquired or as a consequence of having used them during a particular period for purposes other than to produce inventories during that period. Double entry for the acquisition of PPE will be as Dr. PPE. CR bank or liability toward supplier. Measurement after recognition. Every usage of PPE item reduces its value and its useful life due to wearing out and consumption. Moreover, this process is named depreciation of PPE assets. Therefore, depreciation is a monetary measure that reflects the fact that an asset physically deteriorates for different reasons. The matching concept is important in the understanding of the depreciation concept. It states that costs should be included in the same period as the sales those costs help to produce. Acquisition of PPE assets happened in one period, but it will be used in the production of goods or services that it will help to produce over several future periods. Calculating and accounting for depreciation starts with determination of how much of the PPE asset cost should be matched against sales in each period. The depreciation charge is usually recognized in profit and loss on a systematic basis over its useful life. Useful life is a period the asset will be used beneficially to the company. In order to show in the financial statements the true value of PPE assets, it is necessary to account for depreciation in order to bring assets to the current value net book value, initial cost less depreciation. Double entry for depreciation is Dr. Depreciation expense, profit and loss account. CR accumulated depreciation, balance sheet account. Some PPE assets have unlimited useful life and do not wear out and therefore, they will not be depreciated. An example of such asset is land. It has unlimited useful life, can be used for a really long period of time, it does not wear out. Nevertheless, the value of the land may change over time. In addition, to reflect the current value of a land owned by the company, the services of professional evaluator are required. Long-term intangible assets. Intangible assets are identifiable non-monetary assets without physical substance held for use in the production or supply of goods or services, for rental to others, or for administrative purposes. An asset is identifiable if it either is separable, capable of being separated or divided from the entity and sold, transferred, licensed, rented or exchanged, either individually or together with a related contract, or arises from contractual or other legal rights, regardless of whether those rights are transferable or separable from the entity or from other rights and obligations. Some examples of intangible assets are research and development expenditure, patents, licenses, copyrights, trademarks including brand names and publishing titles, goodwill and customer loyalty, initial recognition and measurement. An entity controls an asset if the entity has the power to obtain the future economic benefits from the underlying resources and to restrict the access of others to those benefits. The capacity of an entity to control the future economic benefits from an intangible asset would normally occur from legal rights. The basis for the recognition of intangible assets is found in IAS 38, on the basis of which a company should recognize the intangible asset if it is probable that future economic benefits specifically attributable to the asset will flow to the entity and the cost of the asset can be measured reliably. An intangible asset should be initially recognized at cost. The cost of separately acquired intangible asset comprises its purchase price, including import duties and non-refundable purchase taxes, after deducting trade discounts, and any directly attributable cost of preparing the asset for its intended use, professional fees from bringing the asset to its working condition, costs of testing whether assets is functioning properly, etc. Double entry for the acquisition of intangible asset would be Dr. Intangible asset, like trademark, CR bank cash or liability towards creditor. Measurement after recognition. There are two acceptable bases for the measurement of intangible assets. An entity should choose the cost model or the revaluation model as its accounting policy. If an intangible asset is accounted for using the revaluation model, then all the other assets in its class shall be also accounted for using the same model, unless there is no active market for those assets. A class of intangible asset means the group of asset with similar nature and use in an entity's operations. The cost model provides that after initial recognition, an intangible asset shall be carried at its cost less any accumulated amortization and any accumulated impairment losses. The revaluation model provides that after initial recognition, an intangible asset shall be carried at a revalued amount, being its fair value at the date of the revaluation, measured by reference to an active market, less any subsequent amortization and any subsequent accumulated impairment losses. Revaluation shall be made regularly that, at the end of the reporting period, the carrying amount of an asset does not differ from its fair value. Carrying amount is the amount at which an asset is recognized in the statement of financial position after deducting any accumulated amortization and accumulated impairment losses. Fair value is the price that would be received to sell an asset or pay to transfer a liability between market participants at the measurement date. An impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. An entity shall assess whether the useful life of an intangible asset is finite or indefinite, and if finite, they determine the length of this life. Useful life is the period over which an asset is expected to be available for use by an entity, or the number of production or similar units expected to be obtained from the asset by an entity. An intangible asset shall be regarded by the entity as having an indefinite useful life when, based on an analysis of all of the relevant factors, the entity cannot foresee the limit to the period over which the asset is expected to generate cash inflows for the entity. An intangible asset with a finite useful life is amortized and an intangible asset with an indefinite life is not. The depreciable amount of an intangible asset with finite useful life should be allocated on a systematic basis over its useful life. Amortization starts when the asset is available for use. The residual value of an intangible asset is the estimated amount that an entity would currently obtain from disposal of the asset, after deducting the estimated costs of disposal, if the asset were already of the age and in the condition expected at the end of its life. The residual value of an intangible asset with a finite useful life is assumed to be zero, unless there is a commitment by a third party to purchase the asset at the end of its useful life, or there is an active market for the asset. Double entry for amortization of intangible assets would be as Dr. Amortization expense, profit and loss account. CR accumulated amortization, balance sheet account. R&D expenditures represent expenditure incurred for the research and development of new products and technologies whose results are expected to be used over a period of more than a year. These include investing in research and studies for acquiring innovation at the founding, expert services, appraisers, a meeting room for the founding assembly, and the like. Investments in patents, licenses, concessions, trademarks, franchises, investment in leased assets, and similar rights are a form of intangible assets that the company uses to earn its income over a period of more than a year. A patent is a right which protects the patent owner, inventor, in the economic exploitation of the invention. The patent can be recorded on the balance sheet under intangible assets only if it is acquired from others. Patents are recorded at the cost of the purchase plus all expenses directly attributable to its preparation for the intended use. A license is the purchase of a right, that is permission to exploit someone's patented inventions, protected industrial traditions and the like, protected intangible assets. This purchase indicates the time right to use it or the right to produce a certain amount of a product. A franchise is a right acquired when one company pays the other one a fee for a particular business. It usually includes a right to sell certain products or provide a franchise service by using a trademark or service mark, organization and the technology of sales or delivering the service. Well-known examples of a franchise are McDonald's, Burger King, Pizza Hut and others in the fast food industry, fashion brands. Usually, the fee is paid in advance for multiple periods or more financial years, and therefore the franchise is characterized as long-term intangible assets. Investments in rights also include bought intellectual property rights, copyright and publishing rights, customer lists, trademark, know-how, market shares etc. The purchase cost also includes a paid tax that cannot be deducted. A goodwill signifies a higher value of a company that it has thanks to its reputation and similar factors that cannot be measured or it can be difficult to measure them and which result in a higher value of the enterprise. This value is reflected in the positive difference between the values of the enterprise as a whole in comparison to the sum of the value of its individual parts. On the balance sheet, a goodwill is recognized only if it has arisen in the process of acquiring and merging of another company. In accordance with IAS 38, an internally generated goodwill does not meet the recognition criteria as an asset and cannot be recognized as intangible assets on the balance sheet of the company, since it is not a resource that can be identified and controlled by a company and the cost of its acquisition cannot be determined reliably. IAS 38, Group of Authors, 2018. Internally generated brands, mastheads, publishing titles, customer lists and items similar in substance shall not be recognized as intangible assets, since it is impossible to distinguish between expenditure on them with the cost of developing the business as a whole. Non-current financial assets. Long-term financial assets are investments for the purpose of achieving future economic benefits in the form of interest, gains or certain indirect benefits. Investment returns are expected within a period of more than 1 year. Long-term financial assets consist of investments in long-term securities, shares, bonds, treasury bills etc. Long-term deposits. Shares in affiliated companies. Shares in the capital of another company, etc. Financial assets upon acquisition recognized in accounting books at cost in the following double entry will be posted. Acquisition of financial investment. Dr. Financial investment. CR bank cash or liability to pay for acquired investment. At the end of the year, on the last date of the financial statements, financial assets would need to be revalued, in order to be shown at their fair value in the financial statements. If the value of a financial asset will be more than the value it was acquired, then financial asset account will be debited. If no, then financial asset account will be credited, like increase in value of a financial asset, revaluation gain. Dr. Financial investment. CR evaluation reserve, gain from revaluation of assets is shown on this account. Decrease in value of financial asset, impairment loss. Dr. Impairment loss on revaluation. CR financial asset. Non-current receivables. Receivables are debts owed to an entity by its customers for goods or services that have been delivered or used but not yet paid for a period of more than 12 months. Example, if a company provided its client with some services and issued a relevant invoice to him, then the accountant of the company will post the following entry in accounting books. Dr. Debtor, Customer, Balance Sheet Account. CR Rendering of Services, Profit and Loss Account. If there is an indication that customer will pay for that services after 1 year, then this debtor receivable will be classified as a non-current receivable in the accounts of the company. However, if the customer will pay within a year, then this receivable will be classified as current receivable. B. Current assets. Current assets are types of assets that are expected to be converted into money in a very short period of time or in a business cycle within a year. Therefore, those are relatively liquid assets. Current assets include cash and cash equivalents, accounts receivable, inventory, marketable securities, prepaid expenses and other liquid assets that can be converted into cash within 12 months. Current assets include the following categories. Inventories. Current receivables, from customers, affiliated companies, employees, government. Current financial assets, received short-term securities, checks, bills of exchange etc., short-term loans, deposits and down payments, shares in affiliated companies, etc. Cash and cash equivalents, cash in bank, foreign currency etc. Prepayments and deferred expenses, prepaid expenses and accrued income. Current receivables. Current receivables are those receivables that are expected to be realized within a short period of time, up to 1 year. The most common short-term receivables are receivables from customers, government receivables. Cash and bank. Cash, as the most liquid asset, is part of the company's current assets, represented with cash and bank balances. Current financial assets. Short-term financial assets are cash placements for a period shorter than 1 year. The recognition and measurement of short-term financial assets are regulated by IAS 39 Recognition and Measurement Financial Instruments. Current financial assets include loans given to other companies for a period of 1 year and less, purchased securities acquired for sale within a year, given deposits with repayment within nearest 12 months. See liabilities. Liabilities are companies' debts or obligations that arise during the business operation of an entity. Liabilities are settled over time through the transfer of economic benefits including money, goods or services. Liabilities include loans payable, creditors or accounts payable, accrued expenses etc. Liabilities are a vital aspect of an entity because they are used to finance operations and pay for large expansions. The borrowed funds are used to purchase new and more efficient machines that will result in more efficient production at lower costs. The one who lent the funds to the company becomes a lender while the company that is obliged to repay the money is a borrower. The total assets available to the entrepreneur may originate from two sources. A. From creditors, other sources of property, so-called liabilities. B. From the enterprise owner, own sources of assets on the balance sheet are referred to as capital or equity. On the balance sheet, obligations are part of the liabilities and represent other sources of the assets of the enterprise. According to IAS, a liability is defined as an entity's obligations to transfer economic benefits as a result of past transactions or events. Transfer of economic benefits refers to the transfer of cash, or property, the provision of services. Past events means that the event occurred before the liability was raised. Based on maturity, liabilities are divided into A. Non-current liabilities, liabilities with a repayment term of more than 1 year counting from the balance sheet date. B. Current liabilities, liabilities that are expected to be settled within 1 year, counting from the balance sheet date. Characteristics of liabilities. Liabilities are defined as debts or obligations that have arisen from transactions or events in the past and will require settlement in the future. Therefore, the company is now making a commitment to give up the resources in the future. Accrued liabilities arise when current expenditures for which payments will be made in future periods are recognized. Examples of accrued liabilities include loans payable, tax liabilities and wage liabilities etc. Advances received, prepayments. When a potential buyer transfers funds to the bank account of an entity regarding a future delivery of goods or services, a liability for the recipient of an advance is created, therefore, an entity now have to make a delivery or to return the money. After the delivery of goods or services has been made, the entity settles its liability towards the buyer. Long-term liabilities are liabilities with a maturity of more than 1 year. Such liabilities are usually the result of purchases of long-term assets, the purchase of another company, or the refinancing of an existing long-term liability which is about to mature. Unlike non-current, current liabilities are liabilities with a maturity of less than 1 year, and they are a result of regular business transactions. It can be current loans from banks or other company, payable to suppliers, employees. Differences between debts and equity. Enterprises can be financed from two sources, borrowed or their own. In case they are funded from the borrowed capital, then debts or obligations to return the funds are created. On the other hand, enterprises can be financed from their own resources, and that is called the equity. The main difference between them is that the liability to the creditor should be paid within time frame, and the equity is not due. Furthermore, liabilities have priority over the equity in the case of enterprise liquidation. However, the creditors do not thereby have the right to control the business of the enterprise. D. Capital. Capital is the equity or own resources of a company's assets. The capital shows the value of the assets that the owners have invested in their company. In the case of a limited liability company, the capital is expressed as share capital. Own capital represents a permanent source of the company's assets. It is recorded on the liability side of the balance sheet. The value of own capital is equal to the net book value of the company, namely, net book value equals total assets, total liabilities. Capital equals assets, liabilities. Capital is always in connection with the owners of a company, founders, investors, shareholders. Capital is a counterbalance to assets on the balance sheet. From the formula, we can see that the equity in the liability statement shows how much of net worth belongs to the owners of the company. In literature, capital is often referred to as equity, net assets, own capital, or capital and reserves. Capital consists of a subscribed issued share capital, share premium or capital loss, revaluation reserves, statutory reserves, legal reserves, reserves for own shares, other reserves and retained earnings. Capital can be invested in several forms. Money, by paying into the bank account of the company. Contribution in kind, by bringing the plant, equipment, inventories, etc. into the company. Rights, by introducing a patent, license or other rights into the company. Earned equity is the result of the business activities of entrepreneurs. It represents a gain after taxation. We talked about the difference between profit and expense after the profit tax has been paid. If the earned profit of the current year after taxation is not paid to the owners but is retained in the company, then, on the basis of the decision of the company's management, it is transferred to the retained profit or is redistributed to retained profit and reserves. Own capital structure. Based on the balance sheet, the components of own capital are: issued capital, premiums for the issued shares, share premium, revaluation reserves, reserves, statutory, legal, other, retained earnings, loss carried forward, gain, loss for the current year, after taxation. In the accounting books, the following entry will be done upon the issue of shares of the company. A company issued 1,000 shares to its shareholder at €1 each. Dr. shareholder €1,000. CR share capital €1,000. With this entry shows that issued capital of the company is €1,000 and it shows the liability of the shareholder to pay to the company €1,000 for the issued shares. If the shares of the company will be issued at a premium, then the following entry will be done. Company issued 1,000 shares at a nominal price of €1 per share plus a premium of €0.50 for each share. Dr. shareholder €1,500, 1,000 shares x €1 plus 1,000 shares x €0.50. CR share capital €1,000, nominal value of shares. CR share premium €500, premium for all issued shares. The company's own capital can be increased in several ways. Through new members that bring new founding capital into the company. By recapitalization or by increasing the share of founding capital to existing members of the company. With new share issue. By a capital gain by issue shares at a premium. A decrease in a capital occurs when a loss for the current year has been realized. A gain for the current year or the retained earnings for the previous years has been paid to owners or when the dividends are paid to the shareholders. A share has been paid out from the founding capital to the investor who exits from the company. The diminished value of the previously revalued long-term assets has been compensated from the revaluation reserves. Profit and loss account. The profit and loss account is a report showing the business performance of a company over a particular period of time. It shows the total profit and loss of the business and their difference as a gain, in case of positive business operating, or a loss in the case of a negative business operating. The main categories of profit and loss include revenue, or sales, other income, interest income, dividend income, cost of sales, or purchases, interest expense, dividends paid, royalties paid, depreciation and amortization expense, selling, distribution expense, administrative expense, other professional expense, marketing and advertising expense, salaries costs, social insurance expense, rent expense, taxes. Revenue recognition. Revenues represent one of the most important elements of the financial statements, on the basis of which the business performance and measurement in the financial statements are estimated. As regulated by IAS 18 revenue, the recognition of revenue is based on the basic accounting assumption of the occurrence of an event, on the basis of which revenues and expenses are recognized at the time they were incurred, and not at the time of the actual money receipt or payment. Revenue is earned when the main condition of the agreement between the two parties is fulfilled, that is, revenue is recognized when it is probable that future economic benefits will flow into the enterprise and when those benefits can be measured reliably. Therefore, regarding the recognition of revenue, the principle of caution is very important, requiring that the revenue is recognized only when it is certain, while expenditures are recognized even when they are possible. The revenue account is an equity account with a credit balance, meaning that an increase in revenue is posted on the credit side, since revenue increases equity. The sale of goods or services will be reflected in accounting with the flowing entry. Debtor, company's customer. CR revenue, sales of goods or services. Expenditure recognition. As defined by IAS 1, expenditures are one of the 5 elements of the financial report and, together with the revenue, are directly related to the measuring of the financial performance. Expenditures can be recognized in the profit statement if the reduction of future economic benefits results in a decrease in assets or in the increase of liabilities that can be measured reliably. This means that the recognition of expenditures occurs at the same time as the recognition of the increase in liabilities or reduction of assets. Expenses are equity accounts with a debit side, since their balances reduce the overall equity of the company. Therefore, in the company's accounting books, expenses will be recorded as doctor expense. CR bank creditor, if these expenses were not paid yet. Statement of comprehensive income. According to the International Financial Reporting Standards, IFRS, entrepreneurs, that is large enterprises as well as those entrepreneurs whose shares or debt securities are listed or are being prepared for their listing on an organized securities market, are obliged to prepare another comprehensive income report. The report mentioned above is, in fact, a supplement to the statement of profit and loss and includes income and expense items that are not recognized as a gain or loss, but through the capital, that is comprehensive gains. Comprehensive income is a net change in equity for a period not including any owner contributions or distributions. It includes all revenues, gains, expenses, and losses incurred during a period as well as unrealized gains and losses. It gives the external users full information of all the accounts that affect equity of the company during a period. Every Cyprus company should submit to the Registrar of Companies its audited financial statements. Everyone has the right to insight into the publicly available annual financial reports of companies that are obliged to publish them. Every Cyprus company should also submit to the tax authorities its annual tax declaration that is prepared based on the audited accounts of the company. Audited financial statements are mainly prepared for external users. These external users typically fall into 4 main categories: investors, creditors, competitors, regulators. Investors and creditors analyze this set of statements to base their financial decisions on. They also look at extra financial reports like financial statement notes and the management discussion. The income statement and balance sheet accounts are compared with each other to see how efficiently a company is using its assets to generate profits. Company debt and equity levels can also be examined to determine whether companies are properly funding operations and expansions. Most investors and creditors use financial ratios to analyze these comparisons. There is almost no limit to the amount of ratios that can be combined for analysis purposes. Investors and creditors usually compare different companies' ratios to develop an industry standard or benchmark to judge company performance.